This is CGTN, China Global Television Network.
Hello there and welcome to Global Business Africa. We'll be giving you insight into Africa's business and financial markets. I'm Uche Okoronkwo, coming to you from Kenya's capital, Nairobi. Let's start with a look at the markets. Now, emerging market stocks surged to record highs today as we saw ultra-low interest rates and stimulus hopes brightening their prospects. MSCI's index of emerging market stocks jumped more than 1% on the day, with, of course, Asian stocks providing support on the back of positive Chinese GDP data coming out on Monday. Across Africa, markets were pretty muted today. South Africa's JSE was firmer, with investors remaining hopeful that the incoming administration of U.S. President-elect Joe Biden will help to accelerate measures to support the U.S. through the COVID-19 pandemic. Now, also coming up on today's show, South Sudan and Sudan ramp up oil production to bring in more revenues for the two nations. China's economy up by 6.5% in the last quarter of 2020. And COVID-19 drives up internet usage in Africa's most populous nation. Well, South Sudan and Sudan have agreed to increase oil production in a move aimed at generating more revenues for the two neighboring nations. Oil produced in South Sudan is transported by pipeline to Port Sudan. It is then shipped onwards with the oil revenue shared between the two countries. CGTN's Patrick Oyet reports.
Oil money funds more than 98% of South Sudan's government budget. However, oil production and revenue have fallen since 2013. Civil war from 2013 to 2018 destroyed some oil facilities. Petroleum production plummeted from around about 320,000 barrels a day to the current 180,000 barrels a day, according to the Petroleum Ministry. An increase in production will mean more use of oil infrastructure in Sudan, which requires cooperation from Khartoum.
We have agreed that Sudan will have a coordination office in Juba. The ministry will have a coordination office in Juba. We have a coordination office here in Khartoum, and we will also have in Port Sudan, where we receive our goods most of the time. This coordination office are meant to ease communication between the two countries, between the two ministries, and is also meant to ease the operation in the oil fields.
Sudan's new government is still experiencing communal violence in parts of the country. Extra security measures have been put in place. Juba says some of those security measures delay the arrival of vital supplies required in the oil fields. Khartoum is promising to address the situation.
We have directed our taxation officials, security operatives and state governments to prioritize clearing of goods meant for oil fields. This is one way to ensure we increase production.
Investors in South Sudan's oil sector include national oil companies from Malaysia, India and China. Some experts warn that increasing oil production without transparency and accountability in the sector will not benefit many South Sudanese people, but the government insists it wants to increase production, generate more revenue, then invest in infrastructure such as roads and develop the country's agriculture sector. Patrick Oyet, CGTN, Juba, South Sudan.
And still on oil matters, South African refineries owned by Glencore and Petroleum Nasional that make up 43% of the nation's oil refining capacity are expected to remain closed until at least 2022. That is according to energy consultancy CTAC. Here's CGTN's Angelo Coppola with more.
The reasons the refineries remain closed and aren't being upgraded is that there's no policy certainty about the benefits, incentives and cost recoveries for the potential international investors in the new technology. South Africa has also missed the opportunity to build its own refineries due to budget constraints and an underperforming economy.
These international companies can provide the wherewithal to do that, the expertise, they've got the technology transfer ability, they have the experience in doing that. So to my mind, those are the people you want to look after. You don't want to be going into building new refineries. Typically, those take so long, and there are so many decision points along the way that generally may not have been anticipated.
Meanwhile, the offshore finds by Total and its partners have created a lot of optimism and confidence in the future of the local oil industry, specifically in the Mossel Bay area and the small government-owned refinery there. But there is a problem.
Perhaps there's an acceleration program, perhaps there's a workaround there, perhaps they could import in the interim into that refinery. But again, I think PetroSA would want certainty into the future that there is an attractive deal from their side of the Total find. And again, this comes down to, even though that is the national oil company, it comes down to policy certainty again.
The challenge facing the South African refineries is that they are old and need to be refurbished or replaced.
They typically were built during the 60s. And while they do function very, very well, and they've got some excellent technical people, the simple fact is that they won't be able to produce Euro 5 fuels without significant upgrades. That fuel exists on the sea.
Discussions between local and international investors and government ministers have been underway for several years now, with little or no progress being reported.
These discussions always go on and on. And South Africa is not unique. These discussions are happening all over the place. We have the compounded urgency around old refineries, constricted economy, and masses of product available on the world markets at the moment.
All refinery investors are looking for policy certainty. If they don't have that, they're not going to invest. And that's going to leave South Africa with some serious policy decisions to make. I'm Angelo Coppola for CGTN in Johannesburg, South Africa.
Well, let's head to Kenya now, where insurance policy cancellations and withdrawals have surged by nearly a third in the 6 months to June last year. Now, this follows the increase in massive COVID-19-induced layoffs and salary cuts that, of course, have made it difficult for customers to keep up with premium payments. According to the Insurance Regulatory Authority, policy surrenders rose by 26% to $48.4 million. That is up from $38.3 million in the preceding similar period. Now, the number of insurance policy lapses have also surged in the review period. Data from the Association of Kenyan Insurers indicates that the number of policy lapses in life business jumped by 26.7% to 40,411, with the value involved hitting $13.9 million. Well, let's now delve further into the impact of COVID-19 on Kenya's insurance industry. We're joined by Tom Gishuhi. He is the Chief Executive at the Association of Kenyan Insurers. Great to have you on the show with us today, Mr. Gishuhi. Now, of course, typically one would expect the insurance sector to be generally well prepared for major loss events, of course, such as a pandemic. Give us a sense of the extent that COVID-19 and, of course, the resulting policy lapses, cancellations and withdrawals in the sector, how are all this impacting the bottom line for Kenya's insurance firms?
Thank you very much for having me. In your opening statement, you have summarized it very well, that the surrenders, the cancellations, the withdrawals, particularly so in life insurance business, has been as a result of job losses, salary cuts, closure of small and medium businesses, which under normal circumstances employ just about 70 to 80% of Kenyans. And therefore, the impact has been that if you lose your job, then you very quickly would want to rush to where you can very easily access cash. And for those persons who had insurance policies, life insurance policies, went for surrender values. Others were not able to renew their policies because they needed to spare the little cash that they had to be able to put food on the table. So the impact has been accelerated withdrawals, even from pension business, accelerated cancellations, so on and so forth, purely because Kenyans just didn't have money, and therefore they needed to access cash to be able to meet their other daily needs. Of course, this has come with will have a big impact on the bottom line of the insurance companies, because this comes reduced revenues because one, of the cancellations, two, of the withdrawals, and number three, and most importantly, because of reduced sales, purely because of the lockdown that we experienced. And most of the insurance business in Kenya is sold by walk-in, walk-out agents, insurance agents. With the lockdown, of course, they could not make to reach the potential customers, and therefore the sales also were impacted. So if you put all those factors together, they all point to reduced revenues. Now, reduced revenues would also impact investment income, because you have to have the revenues that then you invest and get investment income, which is part of what goes into helping insurance companies in terms of their bottom line. So reduced revenues and reduced investment income. Yeah.
Well, let's delve further into investment income. We hear that many insurers are now forced to divest from traditional investments, such as the bond market. Give us a sense of how COVID-19 and this rush to meet the increase in withdrawal requests is now influencing how insurance firms invest their funds.
Now, with the accelerated demand for cash, the natural thing for insurance companies to do is one thing, to make sure that they are reasonably liquid. And to be able to be liquid, there are two or three things that they need to do. One, divest from long-term investment instruments like treasury bonds, probably divert the money to shorter period investment vehicles like treasury bills, fixed deposits, so on and so forth, so that you are liquid enough so that when your customers come in for cash, then you are able to provide the cash. So the accelerated demand for cash has made it, forced insurance companies to invest in short-term investment vehicles, and also liquidate some of the long-term investments, so to be liquid. And of course, that also has another impact on the bottom line, in the sense that long-term investment instruments tend to come with higher interest rates. So if you're going to invest in short-term investment vehicles, then your return on investments is certainly impacted. So if you take all these factors put together, then you can see exactly what the end result, when the numbers finally come out. And I'm talking about the numbers for 2020, audited numbers, because IRA numbers are not audited numbers. Right. When the audited numbers finally come out, the impact is likely to be huge.
Well, on that note, I'm interested to know, Mr. Gishuhi, what you think will be the long-term impact of this pandemic, and of course, its disruptions on how insurance firms do business going forward, the sectors they target. Are we looking at new approaches that insurers should be considering in terms of tailored products and processes going forward? What are your thoughts?
I believe the response to this by insurance companies, amongst many, because I can only probably just conjecture in terms of what insurance companies must do to mitigate the impact of COVID going forward. One is to come up with, to restructure some of their products so that they are a lot better affordable than before. In other words, come up with slightly cheaper products which can be the customers with reduced income then will be able to purchase. That is one of the reactions. The other one is to look for ways of cutting down on costs of doing business. And what I suspect is likely to happen is that insurance companies are going to invest heavily in technology so that they can reduce their cost of doing business. And what I have in mind, particularly so when it comes to life insurance business, is coming up with the technology platforms that are going to facilitate insurance companies to sell their products online, provide services online, receive their premiums using online digital platforms, and pay their claims online using digital platforms. That by itself will not only cut down on expenses of management, but it will cut down substantially on the cost of distribution, because for life insurance, the cost of distribution is probably the highest. You're looking at a selling of a life insurance product right. On a walk-in, walk-out by insurance agents. Sometimes they take as much as 50% of the premium that is paid by the customer. So if you're able to use a digital platform so that you distribute your products using digital platforms, then you're likely to cut down substantially on costs. The other thing that insurance companies will have to do is we have, even as we are speaking now, a lot of insurance companies from home, and therefore they will also have to invest in digital tools or in electronic tools, right. So that they are able then to empower their staff to be able to operate from home. Right. I am specifically talking about technology because this is going to be one area that insurance companies must invest very heavily in terms of what you may want to call front office operations and back end operations.
Right. And certainly we are seeing that shift across many sectors to digital methods and of course technology given the pandemic. I do apologize, sir. We do have to leave it there. Thank you so much for joining us on the show and for your insights. That was Tom Gishuhi. He is the Chief Executive at the Association of Kenyan Insurers. Well, let's now turn our attention to some corporate headlines. Glencore has agreed to sell its majority stake in Mopani copper mines for $1.5 billion. That's following the acquisition by the Zambian government. However, the mining firm will only receive $1 upfront. Glencore has been in talks with the state about Mopani since last year. That's after the two clashed on the future of the mine, which has been unprofitable for years. Meanwhile, shares of combined investor wealth in Kenya's Safaricom have hit a record at 60.2% on a sustained price rally that's deepening its significance at the Nairobi Securities Exchange. The telecoms firm valuation jumped by $762.2 million since the year started, closing yesterday's trading at $13.2 billion. Now, Safaricom's share price closed at 33 cents as of Monday, having gained 6.13% year on year. And General Motors and Microsoft Corporation are leading a $2 billion investment round in self-driving car startup Cruise LLC. It is a deal that will bring the software giant's cloud and edge computing capabilities to the venture. Now, the investment is expected to raise Cruise's post-investment valuation to an estimated $30 billion. That's up from $19 billion in 2019. And finally, Boeing 737 MAX plane is set to receive its final clearance to resume flying in Europe next week. Europe's Aviation Safety Agency suspended all flights of the plane in March 2019 after 2 fatal crashes that have been attributed to flawed flight control software. The agency says a separate certification of the MAX 200 variant is likely to follow in the coming weeks, allowing flights to resume before summer. And that is a look at our corporate headlines. Well, we are taking a short break now, still coming up on the show. Portugal's largest construction firm gets the go-ahead to build Nigeria's $2 billion railway. And we bring you hot discounts from Egypt as the country lures winter travelers.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global business, only on CGTN.
Every story starts out like this.
Okay, we'll head up now.
But beyond the rush of the numbers, there's always a more fundamental question. What happened? Who has been affected? When market-moving decisions are made, who's responsible? And why?
Let's get some reaction on ground. Joining us in Johannesburg is Sudan. Hello, Nairobi.
This is how all stories begin. See how they end. Only on Global Business.
There's more to this place than just glorious landscapes. There's more to it than just, say, Table Mountain or glorious, endless salt flats. There's more to it than countries that are home to some of the deepest mines in the world. There is so much more to this place, even if it is home to some of the finest diamonds on the planet. It is the sheer diversity of the people who call Southern Africa home, and the relentless drive to make it a better place that make it so special. And we know that because this too is home. No one knows Southern Africa like we do. CGTN, see the difference.
Africa is the nexus of enterprise, and Global Business will tell you why it matters.
From the mega investment projects to multi-billion-dollar mergers and acquisitions.
Africa today collects, just in terms of revenues for taxes alone, $545 billion a year. If you take 10% of that and you devote it to the energy sector, problem solved.
All this on Global Business, weekdays at this time on CGTN. Welcome back. Well, let's head to Nigeria now, where the government has awarded Portugal's largest construction firm, Mota Engil, the contract to build a railway line between Nigeria and neighboring Niger. The 284-kilometer cross-border rail line will link the northern Nigerian city of Kano with Niger's Maradi, and it is worth about $1.96 billion. As CGTN's Deji Batmus now reports, Nigeria is building rail networks across the country in order to help address its poor transport infrastructure that has stymied economic growth for decades.
The rail project is expected to commence as soon as the funding process is concluded and the funds are made available. The single-track standard gauge rail line will run through 3 northern states in Nigeria, linking them with the town of Maradi in landlocked neighboring Niger. It will also connect the southern Nigerian ports of Lagos and Lekki, effectively connecting the Nigerian commercial capital to Niger.
So what we are doing by extending our railroad to Maradi is to make a strong presence and compete for export and import of goods and raw materials from Maradi to leave through Lagos Port and come through Lagos Port.
The construction is expected to take 2 years and 8 months and further facilitate trade and commerce in northern Nigeria, which have been seriously hampered by banditry and insurgency.
This is going to make Nigeria a strategic maritime hub for Africa. And so we should be anxious to make sure that we are opening up all the trading routes from Nigeria to all other countries in the hinterland.
Mixed reactions have trailed the project since it was announced by the government, with some critics questioning its viability. But some experts say the rail line is crucial to Nigeria's quest to expand its trade influence in the region.
This is so important to Nigeria's competitiveness because Niger is a landlocked country. And Jim, that road, that rail line heading out to Maradi has a catchment. You know, within 100 miles radius, you will get Mali, Niger, and even Burkina Faso is in your axis, and also Benin, Republic of Benin. That is crucial for transnational trade. We've gone into AFCTA.
Nigeria is modernizing its rail infrastructure to ease movement of goods and services across the country. It's commenced trial operation on the 156-kilometer double-track Lagos-Ibadan rail line, hoping to begin full operation soon. Plans are already underway for the next phase of the rail project, which will link Ibadan in the country's south to Kano in its north. Deji Badmos, CGTN, Lagos, Nigeria.
Now, in an effort to revive Egypt's struggling tourism industry, the country has now launched the Enjoy Your Winter in Egypt initiative. It includes flight and hotel discounts for local and foreign travelers. Since reopening in July, Egypt has reported an uptick in tourism, but of course levels still remain nowhere near the North African state's pre-pandemic levels. Here's CGTN's Yasser Hakim with more on this campaign.
Egypt's tourism industry has been suffering immensely since the outbreak of the COVID-19 pandemic in early 2020. Statistics show there has been a 77% year-on-year drop in foreign arrivals and an 85 to 92% collapse in revenue last year. Now the government is having to look inwards to revive the industry, which accounted for 11.9% of Egypt's GDP pre-COVID. Atif Abdulatif, who owns several hotels in the Red Sea, says domestic tourism should not be ignored.
Our last resort, which is our hope in the tourism sector at the moment, is domestic tourism. This type of tourism has developed a lot in the last 10 years as Egyptians began to travel domestically and to know more about the beauty of their country. Domestic tourism is not an alternative to foreign tourism, but it can support us during times of crisis.
The government is advertising the Enjoy Winter in Egypt campaign by making use of the current 2-month mid-year vacation and the surge in online education. The main advertised destinations, Sharm el-Sheikh, Hurghada, Luxor and Aswan, all enjoy warm weather at this time of year. They also have near zero cases of coronavirus in the country.
It is a good idea to help bring life back to the dead tourism industry. I'm actually going through several offers so that I can travel during the vacation. It is important to help keep the industry operating, even if at half capacity, and to help keep employees in their jobs.
The second wave of the coronavirus outbreak could hinder such efforts. There's been a surge in corona cases during winter. So many people are afraid to travel or move around. But I hope the campaign succeeds because tourism needs a lot of support.
Despite its heavy losses since the pandemic outbreak, the national air carrier Egypt Air is offering special discounts, which has been facilitated by a slash in fuel prices by the Petroleum Ministry.
This offer will start on the 15th for the holiday season in Egypt, and we hope that it will give high impact on the situation of life.
Those who can't afford plane tickets can still travel to their favorite spots.
More Egyptians drive to the resort cities now, especially after the huge upgrade in the road and highway systems. Road trips have become more safer, smoother and faster than before. Others use tourist buses or public transport. There are also group trips organized by many institutions, companies and clubs for employees and members.
But they all still have to adhere to strict anti-COVID health measures. Hotels and resorts, for instance, are allowed only a maximum 50% occupancy rate, and there's a ban on all parties or gatherings. Locals might not be spending as much as foreign visitors, nor do they provide hard currency, but the revenue from domestic tourism can sustain the industry until international travel resumes fully. Yasser Hakim for CGTN, Cairo.
Meanwhile, Tunisia's pandemic-ravaged tourism sector is starting at another period of uncertainty. This as the country grapples to contain a surge in COVID-19 infections. The North African nation's COVID-19 task force imposed new restrictions that complicate recovery for the vital tourism industry, whose revenue plunged 65% in 2020. From Tunis, here is CGTN's Adnan Ashaushi with the details.
The 4-day general lockdown imposed in Tunisia from January 14th to 17th will be followed by a targeted lockdown that lasts until January 24th. All public and private events, gatherings and intercity travel have been banned, while the curfew is still in place. Players in the tourism industry have denounced the new measures, which they say have paralyzed the industry, but the government maintains that the restrictions are necessary to safeguard lives.
We are aware of the negative repercussions of the pandemic and the lockdown on all economical sectors. Tourism and related activities were hit hard. We regret the damage caused by these restrictions, but the measures are necessary to curb the rate of infections and improve the epidemiological situation.
The Tunisian Hotel Federation has evaluated the impact of the pandemic and the lockdown, which halted mobility globally. The pandemic decimated the country's crucial tourism industry, as revenues plunged by 65% in 2020 compared to 2019 to around $746 million.
2020 was a catastrophic year for tourism. This industry employs some 400,000 direct jobs, and the hotel sector employs 80,000 people. 27,000 jobs were lost in 2 months. The unemployment rate is very high, and the purchasing power of these people is very low. The crisis caused by the tourism industry will lead to the loss of 1 million direct and indirect jobs. This pillar of economy is now facing a huge risk.
Analysts assert that more of the government's targeted support and relief measures will be needed for the industry to continue operating after the end of the pandemic.
The tourism industry will be the last sector to revive because it is the most affected. It is painful to see how tourism has been devastated by the COVID-19 pandemic. The solution is not immediate, but the government's relief effort is considerable. We need to survive and avoid bankruptcy until the end of the crisis. However, keeping the businesses open will be impossible for 70% of the industry.
Tunisia's Tourism and Handicrafts Ministry has set up a joint committee tasked with the revival of the post-COVID-19 tourist activity. This committee is in charge of drawing up an integrated recovery plan to ensure the battered sector recovers from the fallout. According to the National Institute of Statistics, the COVID-19 crisis is having sweeping consequences on tourism jobs, hotels and travel agencies. Experts believe that economic recovery would be impossible without a mass national and international vaccination plan. Adnan Shawashi, CGTN, Tunis.
You're watching Global Business Africa. We're going to take a quick break now, still to come on the show. China's economy up by 6.5% in the last quarter of 2020. And Ford Motors shuts down 3 manufacturing plants in Brazil.
taken me completely out of my depth, but at the same time, it's exciting. It's new, it's different, it's a challenge.
It's really exciting.
Business in Africa is at a crossroads. We celebrate those who are adopting and thriving despite the challenges, from grassroots to big businesses. Global Business takes you along for the ride as we track the making of a giant.
Only on CGTN.
How will your world change today? What happens here? What happens there? Or what you make happen for yourself? If it matters to you, it matters to us too. Your stories are the stories that need to be told. Africa Live. Find your voice.
I try to not let it affect me, but there are days when it does. I'm a human being, and to see patients in a hospital bed and their family members are not there, there's no one there to hold their hand, that human touch, you know?
I just hope everyone can remember that the situation is not permanent and that everything will get better eventually.
Let's recap other headlines today. Medical staff in South Africa are working round the clock to deal with a surge in coronavirus cases. The new COVID-19 variant identified in the country is escalating the situation. The fastest spreading variant is the main driver of the second wave of infections in the country, and doctors hope vaccines will work against the new variant. Meanwhile, Zimbabwe schools are adopting online teaching after the reinstatement of stiff lockdown restrictions. The indefinite postponement of schools reopening comes amid an upsurge in COVID-19 infections. However, O and A level candidates have been allowed to sit for examinations. Teachers offering online classes admit it is not without challenges. And the World Health Organization is calling on countries to only use vaccines that meet rigorous international standards for safety, efficacy and quality as well. Now, to make it easy for the countries to gauge the right vaccine choice, the Africa Centers for Disease Control and Prevention is forming a task force of regulatory agencies to help establish those standards to facilitate the vaccine approval process. And that is a recap of other headlines this hour. Well, let's get you some international news now. China's economy grew more than expected last year, even as the rest of the world was upended by the coronavirus pandemic. The world's second largest economy grew by 6.5% in the last quarter of 2020. That is compared to a year earlier. Now, overall, China grew 2.3% last year. It was China's slowest expansion since the 1970s, but nonetheless, it made it the only major economy to grow last year. China's industrial production, heavily supported by the state, has been at the heart of this recovery. We saw factory output jumping a further 7.1% in the final 3 months of 2020, and that's after growing 5.8% in the previous quarter.
The world continues to fight the pandemic. A lot of economies will face a lot of pressure in 2021 as China continues to grow. China is now playing a bigger role in driving of global companies' earnings internationally. So we rely a lot, the world will rely on consumption demand from China to grow. In the last quarter, or in 2020, there was a lot of trade and demand of Chinese medical equipment, Chinese technologies, and a lot of it happened via e-commerce. So as borders continue to close, we should expect to see more e-commerce trade between China and the rest of the world.
Now, in mid-January, the Trump administration added 9 more Chinese companies onto a Pentagon blacklist for alleged ties to Chinese military firms without offering concrete proof. In this episode of BizBeat, Kate Coy looks at who is the most affected by these actions.
During past 1 year, there are 2 weapons that Trump administration used to ban the investments and business conducts of Chinese companies. One is the entity list from U.S. Department of Commerce, and the second one is the list from U.S. Defense Department on companies that they claim are owned or controlled by China's military. Several days ago, 9 more new companies are added onto the Pentagon's list. Trump administration disclosed these 9 names without disclosing how the conclusion was drawn, among which there is a company called Xiaomi. Xiaomi is a privately owned company listed on Hong Kong Stock Exchange and now has surpassed Apple to become the 3rd largest smartphone maker. Xiaomi has no market presence in the United States, and the company issued a public filing on the stock exchange saying that there is no direct or indirect ownership by China's military and its affiliates. This is not the first time that Trump put such groundless allegation onto Chinese companies, which has caused irrevocable damage onto the bilateral commerce relationship, and most importantly, the trust that company needs while conducting business in the United States. The International Emergency Economic Power Act grants U.S. President the power to protect America against unusual and extraordinary threat. However, first of all, such power is largely undefined. And secondly, also, the most absurdly, how can a company with 0 market presence in the U.S. threaten U.S. economy unusually and extraordinarily, so that the president has to ban its investment and deny its potential market access? All the scene that Trump put on is nothing else but thinly veiled double standard. When the situation is favorable to him, he's all for it. Otherwise, they are all unjustified. But who will get hit the most? Even in the end, all these investors has to be forced out of the Chinese companies. There's still ample liquidity on the market, but the damage will be collateral. Wall Street every year pockets billions of fees from dealing with Chinese issuers, while U.S. companies such as Tesla makes 25% to 40% of its electric cars in China. So if Trump keeps being absurd, he will only lift a rock to hit his own foot.
Well, let's move on now. Last week, American vehicle manufacturer Ford Motors announced that it will close its 3 manufacturing plants in Brazil. It cited restructuring plans and the COVID-19 pandemic. Now, CGTN's Paulo Cabral revisits the incident.
In 1919, the Ford Motor Company opened its first assembly plant in Brazil. More than 100 years later, it announced the closure of their last 3 plants in the country, following the São Bernardo do Campo plant closure in 2019. In the industrial outskirts of São Paulo, about 5,000 jobs will be cut. In this video, these workers from the Taubaté plant in São Paulo's countryside are protesting the closure. Ford said in a statement that it's reorganizing its production structure in South America to increase margins and generate more cash flow.
It took me a while even to take this seriously. It felt like somebody was joking with us. But then I got home, I saw my kids, and I felt really unsure about the future.
The automakers' dealerships will continue to operate in Brazil, selling cars brought from other countries, mostly Argentina and Uruguay, and offering services to customers.
But why now? Because they were not making profits here in the Brazilian operation. They have an SUV here, they have the EcoSport. However, They were not making money. And why they are not making money? First, because their costs are high and because the revenues are low. This may be simplistic, but why the costs are high? Because the volume are not achieving their full capacity, the capacity of their production.
Local authorities tried to encourage another automaker to take over Ford's facilities. However, that was not possible. The land was bought by a real estate developer, and it's not clear yet what will happen to it. The São Bernardo plant closed down in October 2019 after 52 years, and at a time when Ford only spoke of their intention to stop production of trucks in the country. This union leader says it's a symbol of the loss of industrial jobs in Brazil.
O governo federal não faz nada.
The federal government didn't help. There was an automaker who was interested in acquiring the plant, but the federal government did not help with incentives or public investment. Even after there were 3 Chinese groups looking into it, but then the pandemic came and everything had to stand still.
Ford's plant closures in Brazil have to do with the crisis caused by the COVID-19 pandemic, but also reflect changes in the global production and flow of cars. Paulo Cabral, CGTN, São Bernardo do Campo, Brazil.
Meanwhile, Dubai has unveiled the signature pavilion for the upcoming Expo 2020. It is built with awareness about environmental challenges. The event was postponed due to the pandemic, but is scheduled to open later this year.
This is the first pavilion completed for the Dubai World Expo in the United Arab Emirates. The theme is sustainable development. The pavilion features a water recycling system, capturing rain in a vast underground system. It is also equipped with a towering 130-meter-wide canopy blanketed with thousands of solar panels. The structure cost more than $270 million. It is designed to produce as much electricity as it uses, making it both energy and carbon neutral. Visitors can get involved in the immersive experience, focusing on ocean and forest. There are also interactive exhibits on the history of environmental decline and dangers of overconsumption. Organizers of the event say 85% of the site's trash will be diverted from landfills and 80% of new buildings will live on afterwards as educational centers, residential buildings, or offices. Dubai's Expo is expected to open on October 1st this year and run through March 31st, 2022. And the pavilion is open to visitors starting January 22nd. Various measures are taken to ensure visitors' safety, such as thermal checks, social distancing squares, and providing loads of hand sanitizers. Dubai's Expo 2020 is expected to draw 25 million visitors and a flurry of business deals. Yang Ye, CGTN.
And shifting focus now, here's a look at commodity markets today. Let's put a spotlight on cocoa prices. Now, prices have recovered a bit in recent days amid better than expected grinding data for the fourth quarter. However, cocoa futures are now trading about 7% below a late November peak in London, as of course concerns about slowing demand weighed on prices. Meanwhile, oil prices climbing today as optimism that government stimulus will eventually lift global economic growth and oil demand did help to trump concerns about the International Energy Agency saying that oil demand recovery will take a hit from a spike in new coronavirus cases. Well, let's take a short break now. Still coming up on the show. COVID-19 drives up internet usage in Africa's most populous nation. And an Egypt project aims to digitally connect cities across the DRC.
Africa is a continent of diversity, with varied climates and enchanting geography. And a people so distinct, but with a shared enduring spirit. We are at the heart of the continent to bring you the untold stories.
Let's have a look.
We celebrate Africa as it shapes its own destiny.
Tunis, Cairo,
Syria,
Juba,
Johannesburg,
Ethiopia, Tanzania.
Africa Live. Find your voice.
Images may appear to be identical, but looks can be deceiving. The difference is not always obvious. It has to be discovered. There are always different sides to a story. We put the focus on the details. To see more, to understand better. CGTN. See the difference.
You don't find the stories of North Africa by sitting on the sidelines. No one else will take you where we can in North Africa. And no one else will show you what it's all about. CGTN, see the difference.
And Nigeria's internet subscribers hit 151 million in the third quarter of 2020. That is according to the latest data from the country's Bureau of Statistics. Now, CGTN's Kelechi Mekalam reports a combination of factors, mainly driven by the outbreak of the COVID-19 pandemic, have helped to accelerate the West African nation's internet subscription.
Oluwakpo Samuel runs this one-stop shop for internet services in Nigeria's capital, Abuja. She vends internet hardware and data subscription for major telcos in the country. Her customer base has increased by about 65% since March 2020, recording a turnover of over 500%.
Before COVID, you have people taking about 15 gig, 30 gig and still tell you, oh, I can't exhaust this, it's too much. But when the COVID came and all of that, you have people taking up to like 350 gig in a month. The impact, I must say, has been positive because, of course, now we have more people subscribed to your platform, more people paying, and the turnover has been massive.
According to the Oxford Business Group, Nigeria's telecom market is one of the fastest growing in the world and the largest in Africa. Internet subscribers rose by 7.88 million in the third quarter of 2020 to hit 151.5 million. The surge was mainly driven by the COVID-19 lockdown.
It all started with the people staying home and then they had to study online. And then offices shutting down and then they had to work from home. And then I would also include boredom. A lot of people were bored staying at home and they had absolutely nothing to do. So most times their company is the Netflix, which also consumes a lot of data.
We have strong policy that is driving the growth of the sector. You see where a situation where the sector is well manned, well regulated, well monitored. And this allows for the progress or the growth we're seeing because of the role the NCC and the other agencies play, and then the policy drive around it, particularly with the Buhari administration policy around communication and all of that.
The telecom sector is seen as a huge contributor to the nation's economy. Besides job creation and business growth, it accounted for about 14.30% of the national GDP in the third quarter of 2020. That's compared to 10.6% recorded in the previous year. Many are now taking advantage of the vibrancy offered by the telecoms industry and diversifying their sources of income. Kelechi Emekalam, CGTN Abuja, Nigeria.
Meanwhile, Egypt's Benya capital is set to establish a high-speed telecom infrastructure network in the Democratic Republic of Congo. Now, the project will digitally connect cities across the DRC. It is aimed at improving accessibility to high-quality and high-speed network services. CGTN's Yasser Hakim reports.
The project, which was signed last year in September, entails Benya Capital building a 16,000-kilometer-long fiber optics network in the Democratic Republic of Congo. It is divided into two phases. The first covers the implementation of infrastructure, and the second phase deals with the operation of the network alongside local telecom operators.
The Democratic Republic of Congo is a large country, more than twice the size of Egypt. It's a nation with a lot of potential and opportunities. We established Benya Telecom Company in the DRC to implement our deal. We'll begin with the $485 million project to produce and install fiber optics network around the country. It will be followed by other IT infrastructure projects.
The Egyptian company will digitally connect cities across the DRC and significantly improve accessibility to high-quality and high-speed network services at a low cost.
Technology transfer for African countries is something the DRC values a lot and wants to benefit from Egypt's experience in digital transformation. This is the age of high-speed technology, and there's constant development in this sector, which we in the continent have to keep up with.
Benya Capital chairman says the company intends to leverage Egypt's expertise to support the ICT infrastructure of African countries.
Everyone knows that Africa is the continent of opportunities. Egypt, with its location, history, experience, and human resources, can play an important role. It's important to be involved in the African development process, especially digital transformation and technology infrastructure projects, which I expect to be worth hundreds of billions of dollars in the next 15 years.
Upon completion of the project in DRC, Benya is planning to roll out its expertise in the telecom industry in other African countries. Yasser Hakim for CGTN, Cairo.
And before we close today's show, here's a quick look at Africa's currencies today. South Africa's rand amongst the top gainers amongst the emerging market currencies. It recovered from steep losses over the past few weeks after higher US yields did help to push up the dollar. Now, investors will be watching for cues from data and central bank meetings expected later in the week. Meanwhile, in Nigeria, the Naira has remained pretty stable across forex markets this week, as we saw external reserves continue to rise in the country. It still remains weak due to low oil prices as well as dollar scarcity in the country and a backlog of forex demand. Well, that's it for this edition of Global Business Africa. Remember, you can send your feedback to the contacts on your screen. You can also follow us on our various digital media platforms. From me,